Hey, it's Larry Gonzales over at Align Mortgage, and what a crazy couple days we've had this week. That was a punch in the face. Monday, man, it was ugly. It was one of the 5 biggest increases in interest rates over a day in the last, I think, 20 years. I'm pretty sure that's the number, but it was incredibly high. It was shocking. It was not a fun Monday. I gotta tell you that right now. And then today, the Fed raises the Fed funds rate 75 basis points. And guess what? I'm getting phone calls and texts. What does this mean for my interest rates? Can I even buy a home now? Did interest rates just go through the roof? Hold on a second. All right? Again, when the Fed raises the Fed funds rate, these are mortgage interest rates. This is the Fed funds rate. The Fed funds rate controls the short-term interest rates, all right? The interest rate between banks that are lending overnight. That also has an effect on things like lines of credit, credit cards, and auto loans, all right? But it's not really mortgage rates that it affects directly. They raise the Fed funds rate because inflation is high, and that is one of the only methods they have to bring inflation down. The expectation going into Friday was to have 50 basis points, but after the inflation report on Friday, everybody and their brother, you go to just about any news channel, and they're saying the Fed's got to raise the Fed funds rate by 75 to 100 basis points, anything less, and that will not help out with inflation. And you know what? They're right. And the Fed, not being an organization that overreacts, they shot at 75 basis points with an expectation that July will have a 75 basis point rise too. Why did interest rates go down today? The whole reason for raising the Fed funds rate, inflation is high right now, all right? And the expectation that the Fed's actions will bring down inflation cause interest rates to go down. Right now, our Fed funds rate is between 1.5 and 1.75%. That is the highest it has been since just before COVID in 2020. And one of the things that the Fed is trying to do, they're trying to keep our economy strong. They do that by keeping inflation low. Their goal is 2%, and they also want to keep unemployment low. Well, they've been okay with unemployment, but the economic growth, inflation, they've lost control. Right? We're at the personal consumption expenditure report. We're in the 5s for that, and we want to get down into the 2s. We're not there. Their projection now is that we will not get to inflation at 2% until 2024, probably mid 2024. So they are expecting that inflation is going to plateau here, and then it's going to start to go down. But I personally think that the Fed they're painting a bit of a rosy picture, and they've got those shaded glasses on that are distorting reality. I think inflation is going to continue to go up. It's going to continue to go up for reasons that are really outside of the Fed's control. And because they took action a little too late to get us to where we're at. So I think over the next couple months, inflation will go up. I don't think inflation will really plateau until the fall. And the biggest 2 reasons there are Russia-Ukraine. All right, I've talked about this a million. I was talking about this before Russia invaded Ukraine. All right, the impact of this war is substantial, and it is affecting the entire world. The ripple effects of this war are being felt and will continue to be felt across the world. China has not figured out how to handle COVID. We have no idea what's going on in China, but China is not up to capacity right now. That is causing a continued supply chain shortage or supply chain disruption across the entire world because many of our goods come from China. Those 2 things, the Fed really has no control of, but they just did a 75 basis point hike. They'll probably do another one in July. Then they have another opportunity to do a hike in September, and that's a kind of a good thing because that will give them time to see the effects of this 150 total basis point hike, and the effects of that on our economy. But they predicted that economic growth would be, for the year 2022, would be 1.7%. All right, that is a decrease from the 2.8% that was their prediction in March. I don't know if we're going to get there. Our first quarter projection, or actually our first quarter readings, were at, I think at minus 1 point, I guess a lot of numbers in my head, minus 1.5% GDP for the first quarter. I don't think we're going to be looking too good the second quarter. We'll probably be close to zero or in the negative again. And if we're in the negative again, hey, we are officially in a recession. So let's talk about the rest of the economy. A couple reports that came out. Retail sales down 0.3%. That's kind of a big deal. From April to May, that's 1 month they decreased. Why are retail sales down? I know why. Because we're spending all our money on gas. So we're not spending our money out shopping because we're spending our money on gas. And our electricity bills are all up a little bit too, actually a lot. I know mine is. So retail sales are down. Hey, layoffs. We've been talking about layoffs. Actually, not talking about layoffs. We've had layoffs in the mortgage industry for the last couple months. We were doing loans last year. We were doing, I know I was doing 45 to 50 loans last year a month. I'm not doing that many now. Well, guess what? The real estate community has seen the same thing. The Redfin and Compass both announced that they are laying off some of their staff now. So again, the slowdown in the housing market is having effects, and it's going to cause unemployment to go up. Another report that came out that kind of shows the shift in the market. The National Association of Home Builders, they do a report. They report the heat or an index on the market, and anything above 50 is a growing market. And we've been up in the high 70s, 80s, 90s for the last two years. Well, for the 6th month in a row, all right, the National Association of Home Builder, their sentiment has dropped. Last month was 69. This month it is at 67. And here's the telling thing. Buyer traffic is now below the break even. It's down below 50. All right, it's at 48. So, and why is that? Hey, it's not inventory that's a problem right now. It is inflation and it is interest rates. All right, people are just, it's too expensive to buy. We're not going to work. Despite all that, here's a crazy thing. Mortgage applications were actually up last week, 0.8%. And why is that? Well, because the previous week we had a holiday. So not big news, but mortgage applications are staying pretty consistent. So what does this mean if you're in the market to buy or to sell? If you're in the market to sell, it's gonna get a little tougher to sell your home because buyers are now strapped. And you have a couple of options as a seller. You can keep your home at, say, $1 million for sale. It's going to sit on the market a lot longer. All right, you may, and this is what we're seeing in different parts of the island, you may have to drop your price. I just saw one home dropped its price $100,000. You can do that, or you can keep your home at $1 million, but give a $10,000 or maybe even a $20,000 seller credit to the buyer to help them pay down their closing costs or lower their rate so that the home is more affordable and you get more offers. Guess what? You're still going to get, instead of selling your home for $900,000 because you couldn't sell it and you need to sell it, right? You're going to, that's to $20,000. You're giving up $20,000 to keep that $1 million sales price. I think that is what we're going to start seeing. And guess what that's called? That's called a normal real estate market. No more $100,000 over asking. We just can't do that anymore. That is not a sustainable model. And what we've seen over the last year and a half to 2 years, that's not, it's realistic. It happened, but that's not normal. So now we're going to get back to normal. You're a buyer. Now what? You got to adjust your budget. Rates are higher. Absolutely, rates have changed. You gotta adjust your budget. You need to talk to your loan officer. I sound like a broken record, but you gotta talk to your loan officer and make sure you're still qualified. You don't want to put an offer on a house, get accepted, and say, this mortgage payment is way too high, I'm out. Okay, you could lose some money. You certainly wasted your time, and everyone who's supporting you's done. So make sure you know your budget before you put your offer in. And you might want to start asking for credit. Ask for seller credit, all right, to help you pay your closing costs or to pay down your rate. What I'm hearing a lot now is, I'm afraid I'm going to lose money. I'm afraid the housing bubble is going to burst. Well, I got news for you. In recessions, interest rates typically go down. Home prices typically go up. All right. The expectation for the rest of this year, or in the next 5 years, is to have appreciation annual appreciation just under 5%. That's pretty solid. That is normal, not 25%. That's awesome. That's not normal. So if we have 5% appreciation, you have 26% appreciation or roughly 26% appreciation over 5 years. All right, yeah, you're gonna make some money when you sell them. Guess what you've also been doing over the course of time? You've been paying down equity, that forced savings plan. All right, your principal that goes to pay down your loan. All right, yeah, you're gonna make some money. And you know what that's gonna do? It may not make you a millionaire, but it will help you establish some financial security. Maybe buy that forever home down the line. All right, that's all I got for the day. Remember to like, comment, subscribe on my YouTube page. I love doing what I do. Have a great weekend. Aloha.